morning, Tony Virtue speaking, Virtue and Partners with our regular monthly update, and special welcome to those new followers in LinkedIn. So welcome to you all. A better few weeks out there. I think that the news coming through at the moment generally is better news. Hard to believe we're 10 years now after the GFC, and many of us still got the scars to remind us. But no, news is looking a little bit better now, and I think what to expect is over time interest rates to rise and a growing normalisation, if I can say that, of risk. That's probably a good thing. And generally you'll find that markets work globally in this. It won't just be a case of Australia in isolation. That said, Australia got through the GFC much better, as we well know, than other countries, so less impacted, partly through to the growth in China, partly through to our strong financial services sector. We probably won't be doing as much as other countries with interest rates, but note that the US have lifted theirs, Canada's lifted theirs, and there's a general trend in that direction. Graph shows we've actually underperformed the region over the last year as far as the equity markets. Now, part of that is tax rates, and the news overnight was that the Americans, via the president, looking to drop their corporate rates from 35% down to 20%, and obviously our competitors in Hong Kong, Singapore, much lower tax rates in Australia. So pari passu, if you've got two identical companies, one's paying a higher level of tax than the other, then the valuation is that the lower tax company obviously is valued higher. We do have franking credits in Australia which kind of balance some of that out, but 2 weeks ago I was in London, tax rates down to 17% there. So there is quite an arbitrage in this, and that is in part what you're seeing in the markets there. Overseas, markets again hitting all-time highs in the US, mainly in the technology sector, driven by very few companies that are dominating those markets, all well known to you. Your international fund managers are holding these stocks, so you're not being left behind, and those business models are looking good for the future. They dominate their sector, they're easily expandable into other emerging markets with a fixed cost base. So that just goes to show what monopolistic powers can do. They're making their money as much off their suppliers than their customers. So let's just see how that plays out. We don't have a lot of exposure on our Australian market, so that's again a good reason for us investing internationally. Finally, I couldn't complete a monthly newsletter without the usual commentary on our property market. It does seem to be slowing down in Sydney, which I think is a positive for all of us. That said, this has been an enormous free kick for a lot of people who've been fortunate enough to own property in Sydney over the last 5 years. As these people get a little bit older, there'll be the opportunity to downsize, take some of that equity, reinvest that into income streams for retirement. So it is an enormous free kick. It's not unique to Sydney. You're seeing similar situations in Vancouver, in London, in Hong Kong. Let's just see how that plays out, but a level of stability now would be ideal. There is a graph there that just shows now the disparity between Sydney and Brisbane, so almost 2 to 1 now what you can buy in Brisbane compared to Sydney. So you would think over time that would, and time is the operative word, that would converge there. So that's enough. That's how I see it this month, and I look forward to talking to you next month.